Imagine a company that just made over $1.5 billion in profit, pays down almost no debt, and has analysts predicting it could rise over 15%. Yet its stock price has actually dropped nearly 23% in the past year. That's exactly what's happening right now with ResMed. So, what's going on here? Is the market missing something, or is there a hidden risk that explains why the stock has fallen while the business looks so strong? Let's dig into the numbers and find out. First, let's talk about the size of this business. ResMed currently has about 144 million shares outstanding. And interestingly, that number has actually gone down slightly over the past year. That might sound like a small detail, but it usually means the company has been buying back its own shares, which can be a sign that management believes in the business. On top of that, over 76% of the company is owned by large institutions, like investment funds. When big institutions hold that much of a company, it often means professional investors see something worth holding on to. But here's where things get interesting. Despite that institutional confidence, the stock has fallen almost 23% over the last 52 weeks. At first glance, that sounds like bad news. But when we look deeper into the actual business performance, the story doesn't quite match the stock chart. In the last 12 months, ResMed brought in $5.5 billion in revenue. And out of that, $1.52 billion turned into pure profit. That means for every dollar this company made, about 27 cents was profit. That's a very high profit margin for any business. And it raises the question, if the company is this profitable, why has the stock price been struggling? This is where investors often get confused. A falling stock price doesn't always mean a company is doing poorly. Sometimes it just means the stock became too expensive before, and it's now cooling off. And when we check the valuation, that theory starts to make more sense. The company currently trades at a price-to-earnings ratio of about 20 times its earnings, and interestingly, that ratio is expected to drop to about 18 next year, meaning earnings are expected to grow. That's often seen as a healthier sign than a stock that just keeps climbing without any earnings growth behind it. Now, here's a number that really stands out. ResMed's return on equity is over 25%, and its return on invested capital is nearly 27%. In simple terms, this tells us how efficiently a company turns the money invested in it into profit. Numbers this high usually mean strong, efficient management, and that's not even the most surprising part. This company is also sitting on more cash than debt. It has $1.66 billion in cash while carrying only $843 million in debt. That gives it a positive net cash position of over $800 million. For a business its size, that's a very comfortable financial cushion, and it suggests the company isn't under any real financial pressure, even while its stock is down. But let's not ignore the risks, because there is a piece of information that shifts the picture a little. Short interest, which represents investors betting the stock will go down, sits at over 9% of all shares outstanding. That's a meaningful number, and it tells us that a decent portion of the market is skeptical about where this stock is headed in the near term. So while the business fundamentals look strong, not everyone is convinced the stock price will bounce back quickly. And then there's the dividend story, which adds yet another layer. ResMed has increased its dividend for 13 straight years, with dividend growth of over 13% this past year alone. Yet it only pays out about 23% of its profits as dividends, which means there's plenty of room left for the company to keep growing that payout in the future if it chooses to. So where does that leave us? On one hand, we have a company with strong profit margins, efficient management, more cash than debt, and a growing dividend. On the other hand, we have a stock price that has fallen nearly 23% in a year, with meaningful short interest showing real skepticism from part of the market. The company's next earnings report is coming up soon, which could be the moment that either confirms the market's doubts or proves them wrong. So the real question is this: has the market simply overreacted to a temporary dip, or is there something about ResMed's future that the numbers alone haven't revealed yet?